My name is Russell Price. I'm an Executive Vice President at Nevada State Bank. I'm honored to be here today with my friend and colleague of 7 years, Mr. George Feiger. George is the CEO of Contango Capital Advisors. Contango operates under the name of Nevada State Investment Services in the state of Nevada. Mr. Feiger holds a PhD in economics from Harvard University and was an associate professor of finance at Stanford University Graduate School. George, good morning.
Yeah, good morning, Russell.
And George, before we get started, I wanted to comment a little bit on our business model. One of the things that I am most proud of, 7 years ago, we had started this business with a couple things in mind. But for the most part, we wanted to deliver unbiased advisory services to individuals and families. For those that watch the news on a regular basis or just on an occasional basis, there's constantly in the media talk of conflicts of interest with financial companies, whether that be financial companies that do advisory service to companies, turn around and recommend those same companies to their investors, whether that be a product push of a certain product and the product's not explained in great detail as it relates to risk. So 7 years ago, when we started this, we wanted to make sure that we were very transparent, that we had no other desire other than to give good advice to our clients. Over the last 7 years, we haven't changed those principles. We continue to operate without owning our own mutual fund company. We will not accept in any way, shape, or form fee income or soft dollar arrangements from investment management companies, broker-dealers, and we do no self-dealing. So in other words, we don't buy our bonds from ourselves, our own trading desk. We continue to operate as strictly a registered investment advisory business, which I think is something that most of our clients are aware of, but those of you that have joined us today that are learning more about Nevada State Investment Services and Contango and the services delivered through Nevada State Bank, I think it's very important to understand what our goals are and what we're trying to achieve for you. With that said, George, I wanted to jump right into our discussion. I think the best way to start this is probably to talk about, at a macro level, the overall economy as you see it.
Yes, and I would like to explain that the way we manage client assets is what one might describe as top-down. We look at the way the world economy is going, we look at the state of financial markets, and then we work down to individual types of assets and individual investments. So our whole approach is based on having a deep understanding of the flow of world economic and financial events. And I can summarize our picture here. I wish I could make a happier story out of it. It isn't a story that is unappealing to investors, but it is a very difficult situation. And the points are on the screen in front of you. If we think of the United States, we expect economic growth that we don't think, and we never thought there was going to be a double-dip recession, but growth is slow, and I think all of you have observed that, and real estate and debt problems persist, and I'll mention in a little while, they're going to persist not just for a few more quarters, but for several more years. If you switch your attention to Europe, to Western Europe, the EU, the Eurozone, it has somewhat different problems than we do, but they are very significant problems, and they're also problems that are not going away. Notwithstanding the fact that every couple of weeks the European Central Bank announces a new cure for everything, if you notice the following week the cure seems to fall apart again. Turning to emerging markets, here I'm talking about China, India, and so forth. Emerging markets and the commodity producers dependent on them are doing much better than we are in these advanced economies. By commodity producers, I mean countries like Canada and Australia. You may notice the ever so slight accent, and you'll probably guess it's not from West Texas. So I grew up in Australia. Australia is essentially a mine for China. And Australia hasn't had a recession in 19 years because essentially it pulls stuff out of the ground, puts it on ships, and sends it off to these countries which are growing enormously. So there is vibrant economic growth in the emerging world and in the commodity producers connected to them. But, and the last point that I make before I pass on to the details, while there is vibrant economic growth, all of these markets are now characterized by excessive credit creation. They have inflationary pressures, and there are emotion and sentiment-driven capital flows. So while this is a good thing to have economic growth, it's not a simple bet. So let's talk about these things in greater detail. Let's talk about the U.S. a little bit more. We have slow growth, and because we have slow growth, we have lingering unemployment. This unemployment is substantial and persistent. I'll come back to that in a moment. There is expanding business investment, and there is particularly expanding international business opportunity. This international business opportunity is heavily driven by growth in emerging markets, and the expanding business investment is partly related to that, and partly because our economy is, in its heart, a very vibrant economy, and in pockets, it's already growing quite well. We are broadcasting from San Francisco, which is where Contango's headquarters sit. And if you look around the San Francisco economy, it's actually doing remarkably well. There is a lot of biotech venture money. There is technology venture money. There is commercial real estate construction on a grand scale going on here. House prices in the city of San Francisco are rising rather than falling, whereas elsewhere, of course, it's still a much murkier picture. So what we see in the economy as a whole is islands of prosperity rising from a swamp, and the waters of the swamp are slowly receding, so the islands are getting bigger. And that's the best way to think about the economy. There are still falling housing prices. There are falling housing prices not because people are building more houses than buyers want to buy. In fact, there's essentially no residential construction in the United States. In December, the annual rate of construction of residential property was around 500,000 or 550,000, which is essentially zero. House prices are falling because there is a large and growing backlog of foreclosed property. About 30% by now of mortgages are actually underwater, and a significant proportion of those are underwater by more than about 20%. Experience has now shown that once people's mortgage gets underwater by more than 20%, they have a tendency to walk because they can hand the keys back. And there are enough of these mortgages underwater that we expect a constant flow of walking and therefore a constant supply of foreclosed property. Our best guess, based on the trends that we see, is that house prices across the U.S. on average will stop falling in 2012, and thereafter there'll be a gradual recovery. If you look at commercial real estate, that will recover with the economy, with the exception of retail-related commercial real estate, and that's a point I'll come back to again. So if you're thinking of office properties, industrial properties, as the economy recovers, they will come back, but if you're thinking of shopping malls and things connected with it, we are much more negative for a much longer period on things like that. A couple of points also that we need to think about in terms of the United States. One is that we have deeply depleted retirement resources. People's minds now are focused on the recession, on unemployment, on getting things going again. But if you step back and do what we do, which is manage your assets, we look at the value of these assets. So if you took in the country as a whole, you added up the equity that homeowners have in their houses, all the equity, and you add it all up, and then you take the value of all financial instruments owned by households. So that's pretty roughly household net worth. Then what you see is that aggregate household net worth in the United States today is about what it was 10 years ago. So essentially there's been a lost decade of savings, but everybody's 10 years older. All those baby boomers are 10 years closer to retirement, but they're not 10 years more able to retire. This is something that no one's talking about now. Our prediction is that 24 months from now, many people are going to be talking about this. And finally, of course, in our country, we have unmanageable budget policies. We have unmanageable budget policies at the federal level, the state level, the local level. Again, I'll come back to this in a little bit, but this is a deep and fundamental problem. If we now turn to Europe, we have a different set of issues. The Eurozone has one currency, the euro, and it has many different economies. It has Germany and the Netherlands and so on, which are highly productive industrial economies, and it has these peripheral economies, the so-called pigs, Portugal, Italy, Ireland, Greece, and Spain. These are countries which are in financial trouble, and these are the countries that appear or disappear from your newspapers and television. They're in trouble, there's a solution, then they come back, and they're in trouble again. And the fundamental difficulty is not a credit difficulty in itself, it's that productivity has grown very differently between the northern European countries and these peripheral countries. So if you looked at the productivity of labor, and therefore the cost of labor, German workers are the highest paid workers in the world on a dollar per hour basis. They're the most expensive people to employ. Notwithstanding that, the cost of using German labor has fallen every year for the last 10 years because their productivity has risen faster than their wages. So while Germans are earning a lot per hour, they produce even more per hour. And so labor productivity in Germany has grown by about 10% between 2000 and 2010. If you look at countries like Portugal or Greece or Spain, labor productivity in that sense of cost to produce output has deteriorated by around 30%. So there's a 40% productivity differential grown between Germany and these other countries. This has often happened in the past, and historically countries have devalued their currency. That means, in effect, the cost has fallen with the devaluation of the currency. They can't do that now, so they're all locked together in a way which is fundamentally economically unsustainable. The problem is not just that. Whereas in the United States, if states and municipalities want to borrow, they have the municipal bond market. In Europe, states, municipalities, countries borrow from banks. So the financial problems of these peripheral countries, Portugal, Italy, Ireland, Greece, and Spain, are actually problems of the banking system. And the banking system not only supports them, it supports good old regular business, consumer credit, and everything else. So if these countries don't pay back, the banking system gets in trouble, and you really could have a double-dip recession in much of Europe. So this is a fundamental problem in the Eurozone. We're very negative on the current situation. And we express this, as I'll say again, by being rather cautious about investing in the euro. If the euro was running yesterday, I think $1.35 to the euro, our expectation is that with some ups and downs, it will depreciate. At the point where the euro gets to somewhere around $1.10 to the euro, or even to parity, we will jump in and we will start buying German stocks and German bonds, not Portuguese, but the German ones, because that will become a bargain. But this is something to watch. Emerging markets, I've already commented on. For the first time in a couple of hundred years, these countries have genuinely self-sustaining economic growth. China, India, Vietnam, Indonesia, these are huge places. China alone has a quarter of the world's population. You add in India and a few of the others, you've got half the world. And these people are now becoming, compared to where they were, prosperous, and they have growth that doesn't depend on us. And as I said, it's transformed commodity prices and it's transformed the commodity-producing countries, but it has done so in a very unruly way. The stimulus programs that the Chinese and the Indians and others put in place at the height of the financial crisis were far too large. Because all the Chinese banks are under government control, they managed to increase credit outstanding by 40% in 1 year. That has never happened anywhere else in the world. And the result is there's a mountain of bad debt and all sorts of things. So there is great turbulence to come in these emerging market countries, and that obviously affects how one looks at them from an investment perspective.
George, the new buzz phrase, if you will, out there seems to be jobless recovery. And I guess the question I put out to you, is there such thing, or first, is the economy adding jobs, and can we have a full recovery without job growth?
Yes, there is a big difference between the current recovery and what has happened in the past. The picture you have now is a survey. It's pretty simple. It asks people, are jobs plentiful or are jobs hard to get? And it subtracts the proportion of people who say, gosh, jobs are hard to get, from the proportion who say jobs are plentiful. So if that red line is above the zero line, that means more people think jobs are easy to get than hard. And if it's below, more people think jobs are hard to get than easy. What you can see is that while we have a bad recession, it's the 2010, the right-hand end of this picture, it's been worse. 1982 was a much worse situation, for example. Many, many more people had difficulty finding employment than they do today. And again, 1991, you can see on this picture. So it's not that this recession has been unique in terms of the magnitude of unemployment. What's fundamentally different is the time it takes to get back to the starting level of employment.